Live from Bloomberg's World Headquarters in New York, I'm Scarlet.
And I'm Joe Weisenthal. We're 30 minutes from the close of trading here in the U.S.
Healthcare shares taking a hit after President-elect Donald Trump criticized the drug industry today.
But the question is, what'd you miss?
In his first news conference since the election, Donald Trump confronting some of his biggest political challenges just days before he becomes president, including handing over the business to his sons. We'll take a closer look at his conflicts of interest. He didn't end the remarks without moving a couple of industries. Biotech shares plunging after Trump called for more competitive drug bidding. And on Capitol Hill, Trump's pick for Secretary of State Rex Tillerson in the hot seat, answering questions about his ties to Russia in his confirmation hearing.
Now let's look at where the major averages stand as we head towards the close. Bloomberg's Abigail Doolittle is standing by.
Hi there, Joe. Well, we are looking at small gains for the major averages here in the U.S. We have the Dow, S&P 500, and NASDAQ all higher. In fact, the NASDAQ right now is on pace for yet another record close, the fifth in a row, the longest such winning winning streak since 1999. So some strength there. But this does not tell the full picture. We did see a brief burst of volatility right around the time of President-elect Trump's press conference. Stocks took a slight leg lower. They've now recovered. And where we're seeing more of this uncertainty, more of this volatility, are in some other marketplaces. We had the biotech index in orange. This is an intraday chart. Absolutely plunged at its lows, down about 4%. At that point, on pace for its worst day since the Brexit. We also saw the Bloomberg dollar index in blue take a leg lower, and the 10-year yield at one point was down about 5 basis points. Now, we have seen a little bit of a recovery here, but all this volatility in these other asset classes, especially the dollar and bonds, those are foundational asset classes, suggest that more could be to come. Volatility usually breeds volatility. So some uncertainty here about what Trump will mean for the financial markets. Not seeing it so much in stocks yet, but again, we are seeing it in these other asset classes. And on a longer-term basis, we're really seeing this. Now, this is #BTV86. It's a great chart. In blue, we have the VIX, so the quote-unquote fear gauge around stocks. In purple, we have a bond volatility index. And in white, we have a currency volatility index. And we see that both bonds and currencies, the volatility is starting to be elevated. Again, these are foundational current asset classes, the dog that, if you will, to the tail of stocks, and the volatility increasing there may suggest that stocks could follow suit at some point soon. And finally, to take a look at what the Trump trade relative to sectors looks like. Now, out of the election, we're still looking at financials on top, utilities on bottom, but year to date, we're seeing a little bit of an interesting shift. We have energy on bottom, and today, on those Trump comments around health care, that the drug companies are getting away with murder, and that a bidding process may go into a place, we've seen healthcare take a dip. Tech is now the best sector this year, so it's kind of interesting to see whether or not the Trump trade will stay in place, or if we're going to see a bit of a reversal as we are this year, Scarlet and Joe.
All right, we'll keep an eye on that one. Thank you so much, Abigail Doolittle.
All right, let's turn now to the big political story today, Trump's first press conference since he was elected. Tim O'Brien is a Bloomberg View columnist and also the author of Trump Nation, The Art of Being the Donald. It was published in 2005 and prompted a $5 billion lawsuit from Donald Trump. Did you end up paying? I don't know. Did you end up paying the $5 billion?
No, I did not pay a dime. It was more than I got for my advance, but luckily I didn't have to pay anything in that case.
Okay, so that's good. What most stood out to you from today's press conference? What's your number one headline from it?
He doesn't resolve his financial conflicts of interest. The structure that he says he's going to put in place still leaves his sons in charge of the business, and everything else are fairly porous prophylactics that aren't going to really prevent him from taking advantage of the office for financial gain. I think on other issues, it was a typical Trump press conference. Lots of free association. He wants to get rid of Obamacare, but he still doesn't have a detailed replacement ready for it. We know that he already, his impact on the drug companies today. The other thing that was front and center at the beginning of the news conference was whether the media has been treating him unfairly about allegations around his intersection with Russia.
Right.
And I think that's going to carry the news cycle for a few days.
Right, and him calling out certain networks or certain news organizations as well.
Yeah.
I just want to highlight what he had said specifically about the separation of his job as president and, of course, head of the Trump organization. Let's take a listen.
I could actually run my business and run government at the same time. I don't like the way that looks, but I would be able to do that if I wanted to. I'd be the only one that would be able to do that. You can't do that in any other capacity. But as a president, I could run the Trump Organization, great company, and I could run the country. I do a very good job.
And a little bit of free association there within his proclamations. He is going to hand off the business to his two sons who do not have a role in the administration. His daughter, meantime, resigned from her positions at the Trump Organization and will probably take on some kind of role in the administration.
And his son-in-law.
And his son-in-law as well. What would an extreme or more extreme version of what he's proposing now look like? Would it be completely selling his assets? I wonder, because I want to get a sense of where his decision falls on the spectrum.
Well, I actually think the only way for him to have a clear slate coming into office is to sell the businesses. He's got about at least $1 billion in debt spread across 150 financial institutions around Wall Street. BlackRock, JP Morgan, Deutsche Bank, Wells Fargo, on down the line. All of which he's going to regulate through the Treasury Department when he's in the White House. And it's going to call into question the quality and the intentions of policies that affect all of these lenders that are at the center of his business. And they'll be at the center of the family business whether or not Donald Trump's involved with it or not. Both of the sons are going to be there. They're going to continue to intersect with those organizations. That's a clear problem. Tax policy also is going to affect his business. I think that's less of one than the financial regulations. The financial thing is just a very clear, looming problem that doesn't get cleaned up by turning the business over to the boys.
Something that you wrote in a View column after the election, and there's this misconception, according to you, that the Trump empire is this sprawling global entity, and there's just no way you could ever sell it or he could ever extricate himself, and it has properties everywhere and all kinds of companies. And you say it's actually a pretty small company. It's pretty simple. He's not a mogul by any stretch. Explain that.
Well, and the media's, I think, sort of complicit in this. They keep referring to Trump's vast real estate empire, and it's neither vast nor an empire. Most of the overseas stuff he does are licensing deals. In terms of property, he owns a couple of golf courses in Scotland and one in Ireland. That's it. Domestically, he owns one commercial building outright, 40 Wall Street. And even on 40 Wall Street, he doesn't own the land under the building. All of the other Trump properties in New York that bear his name, for the most part, are condominium buildings where the individual condo units have been sold off to various owners. The point of all of this is to say it would not be as difficult for that business to either be repackaged as a REIT or to be sold off entirely, as his advisors say, and as his lawyer said very unconvincingly during the press conference today.
Right. She came out and gave a 20-minute speech or presentation on the reasons why he was going to stay put.
And compared him to Nelson Rockefeller. He certainly doesn't have assets that are anything close to one of the heirs of Standard Oil.
So I wanted to bring in what Elizabeth Warren of Massachusetts said in response to Trump's plans. Let's listen.
I'm more concerned now than ever because he's not moving where he needs to move. And that is, we need to have him divest. He needs to get rid of his business interests, and he needs to put them in what's called a blind trust.
Okay, so he needs to put in blind trust. He's not going to do that. He's made clear. What's the recourse? Who within government is in a position to address potential conflicts of interest? I mean, is it individual departments?
It's going to have to be the Congress. The president, for good reasons, is not subject to the federal conflict of interest laws.
Why?
Because the thought is that the president, he or she, would touch so many different topics and issues that inevitably they would encounter a conflict of some sort. So the thought was everyone else in the federal government is subject to this law except for the president and the vice president. In lieu of that, what presidents have done traditionally have either divested into a blind trust or divested entirely of their assets. The problem is Trump comes into the Oval Office with a whole host of assets unlike anything any other president has had before. So this really tosses it back to the Congress. What kind of framework do we want to have around the notion of clean government? And that, to me, that's a nonpartisan issue. It's mechanical. And Warren, for her part, on Monday introduced a new act that would require both the vice president and the president going forward to divest. But that's got no chance of getting anywhere in a GOP-controlled Congress unless the GOP wants to play ball.
Finally, on the other stuff that's going on, obviously last night, extraordinary headlines, first out of CNN, then BuzzFeed with his intelligence report. How did he handle this new issue?
This is what Donald Trump is good at. He's very deft at pulling a rabbit out of one hat so people don't look at the rabbit popping out of the other one. In this case, there's been a long summer of allegations, I think some of them unfair, about his intersection with Russia. He doesn't have a long history of actual deal-making in Russia. He's tried. The most he got out of there was a beauty pageant. He is unsophisticated about foreign policy and ill-informed. I think the danger here is that the Kremlin can play him by virtue of his ignorance. But to this point, it's not by virtue of his wallet. Overnight, we had all of these allegations about information that came up through the intelligence community about whether or not the Russian government had compromising material on him. BuzzFeed published the original raw dossier that outlined some of this. And in the press conference, Trump made BuzzFeed's decision to publish the dossier the centerpiece of his answers to questions about whether his relationship with Russia is troublesome, or whether he's troubled by Russian hacking of the 2016
He just never
elections.
touches it.
And so the real substantive issue got buried beneath the debate about the propriety of BuzzFeed publishing fake news. He then proceeded during the news conference, a CNN reporter tried to ask a question. He said, "I'm not going to answer your question. Fake news, fake news, fake news."
All right, Tim O'Brien, Bloomberg View. Really appreciate your perspective. Thanks for coming on.
Tim, of course, also the author of Trump Nation, a book that prompted a $5 billion lawsuit from Donald Trump. Coming up on What You Missed, how is the nation's biggest pension fund going to position its investments? Ted Eliopoulos, the CIO of Calpers, is next. This is Bloomberg.
What do you miss? Last month, the nation's largest pension fund, Calpers, rolled back the expected rate of return on its investments from 7.5% to 7% over the next 3 years. Earlier today, Bloomberg's Eric Schatzker spoke with the CIO of Calpers about what this decision means for the $360 billion fund going forward.
Setting the discount rate, setting the assumed rate of return is really the highest order decision that our system has to make in order to protect the system, provide for the sustainability of our system for generations to come for our beneficiaries. So a very important decision, very consequential. Is 7 the exact number? It's not an exact science. Is it a reasonable number? We believe so. We believe it's a reasonable number over the long term. Again, as a long-term investor, we look out 30, 40, 60 years, and much of the reduction of our assumed rate of return really comes from our intermediate forecast, which for a pension fund like Calpers is about a 10-year
If it were up to you, would the number be lower? And I ask because the argument for a lower assumed return is a powerful one. Right now we live in a low-rate world, right, with commensurately low returns on risk-free assets and everything priced over those risk-free assets. Your own advisor, Wilshire, argued for a 6.2% assumed return, and a number of well-regarded professional investors who've given the subject some thought, like Cliff Asness, for example, of AQR, or Howard Marks of Oaktree, a firm with which Calpers has some investments, think 5 or 5.5 is more realistic.
Well, we looked at all of that advice and the analysis on our own as well. And in establishing our assumed rate of return, we took into account the low interest rate environment that you allude to. And in building our capital market assumptions, we assumed over the next 10 years our fixed income portfolio would achieve about a 3.5% return over that 10-year time frame. I think that's reasonable. And on top of that, in constructing our portfolio and constructing our assumptions that undergo it, we assume our global equity portfolio, our stock portfolio, will return about 6 3/4 over that 10-year period. I think that's a reasonable assumption. The intermediate period that I referred to a little bit earlier, the 10-year period for Calpers, those capital market assumptions add up to that 6.2 number. And I think that's a reasonable number over the 10-year time period, intermediate period, to expect returns from a broadly diversified portfolio like Calpers. Now, our actuaries look out longer than that 10-year period. They took our 10-year forecast, and they look out from years 11 to 60.
Yeah.
And in doing that, they assume some correction, some reversion to the mean in interest rates. I think it's reasonable to look out years 11 to 60 that we're going to have some return to normalcy in the interest rate environment. And if that happens and when that happens, we should expect some higher rates of return in the out years. So when you add all of that together in our analysis, looking out over a 60-year period, is it reasonable to assume that we could achieve a 7% return over that time period? And it's really premised on this intermediate period of getting about a 6% return.
But in that intermediate period, the underfunding situation continues to be exacerbated if you don't hit that bogey.
That's exactly right, and that
makes your job nearly impossible.
It makes it tough. It makes it a challenge, and that's the word that I've used over and over again with our investment committee. And going into this period over the next 10 years, we have quite a challenge in front of us. Not only the market challenges that we just discussed, but the funding status of Calpers. We enter this time period 68% funded, now with the discount rate being lowered, about 64% funded. And we have to pay attention to that. The cash flows of the Calpers system as a maturing fund, the demographics of the baby boomers retiring, the cash flow of Calpers has now turned negative. In other words, we're taking in less cash than we're paying out. So it's a challenge, and we have to pay attention to that. And one of the ways we do that is to, one, yes, invest for the long term, but to pay attention where we can take some risk off the table, where we can redeploy assets within the asset allocation out of equities into other asset classes. We're taking advantage of opportunities to do that.
Let's talk for a moment, Ted, about your critics, because you've got many, whether you like it or not. They say that Calpers' returns over the past couple of years, which have been well south of that new 7% target, are evidence that you and your investment team are failing. And they accuse you of trying to sow panic by advocating, as you did, for a lower assumed rate of return than 7.5%. How do you respond?
No, we're not panicked, and we're cognizant of critics on both sides of the equation, saying that the return assumptions are too low and others saying it's too high. I think what we look at is look at our 20-year return number over the course of the last 20 years. It's right about 7%. Look at our 5-year number. It's at 8%. But we're also, time periods are important. 3-year numbers more like 5. our 10-year number more like 4.5. So there's risk to this portfolio. And in any given year, we know that we might underperform that 7% number or overperform. Our critics don't mention the 18% return that we received 3 years ago. So there's a decent amount of volatility in the portfolio that we account for. And the important thing is, over a very long period of time, as I said, I think a 6% return with a broadly diversified portfolio over the next 10 years is reasonable, and a 7% assumption over a long period of time.
That was the CIO of Calpers speaking with Bloomberg's Eric Schatzker earlier on Bloomberg Markets. And now we're going to bring you a live shot of Rex Tillerson. He's, of course, in the Senate under questioning from senators. He's been nominated, of course, by President-elect Donald Trump to be Secretary of State. Earlier in the day, he took some pretty tough questioning from Marco Rubio about the issue of Russia, for example. Obviously, his view on climate change also came up, free trade.
China has been the latest point of contention here for the senators. Tillerson saying a two-state solution is a dream that all are in pursuit of. He also warns that the U.S. must send China clear signals on the South China Sea and all the issues there. Coming up next, what do Korean import prices tell us about what's coming for consumers? We'll delve into a chart that sheds light on that. This is Bloomberg. I'm Scarlet Fu. What'd you miss? We're focusing on small caps at home and abroad. According to Bank of America Merrill Lynch's Michael Hartnett, small caps outside the U.S. are due for a rebound. This chart shows the MSCI World ex-USA Small Cap Index relative to the MSCI USA Small Cap Ratio. So when the line goes down, as it has been for the last 20 years, it means small caps outside the USA are underperforming versus small caps in the United States. It's now at a 20-year low, this ratio. Michael Hartnett says that little recovery at the far end there, where we've boxed it in red, that is the beginning of something bigger. Overall, he calls this one of his 2017 laggard risk trades. He does see a melt-up in stocks and commodities in the first half, Joe, before a meltdown later in 2017.
Certainly a long potential to mean revert if it ever turns around. All right, I'm looking at inflation. We've been getting strong inflation data out of Germany, China, U.S. wages. Here's the latest. Korean import prices absolutely taking off. You can see that's the white line, up over 3%. up over 9%. Consumer prices still lagging, although they do tend to track each other over time. Nonetheless, it's part and parcel of a global story. It appears that deflation basically everywhere is coming to an end. Now the only question is, how far does this inflation go? But here we are, another piece of the puzzle.
And of course, the China gate prices also helping as well.
That was a big move, yeah.
All right, the market closes next. Let's take a look at the major indexes with less than 4 minutes to go before the close. All three indexes are higher, with the Dow adding 88 points, getting ever closer to 20,000. The S&P 500 advancing by 0.25%. This is Bloomberg. We're moments away from the closing bell. What'd you miss? U.S. stocks rally into the close to end the day higher after President-elect Donald Trump's first press conference since his election. Investors weighing his commitment to policies on economies and economics, and foreign relations. I'm Scarlet Fu.
And I'm Joe Weisenthal. Welcome to our viewers who are tuning in live on Twitter. You can watch our closing bell coverage on Twitter every weekday from 4 to 5 p.m. Eastern.
We begin with our market minutes. The Nasdaq now closing for a fifth day at a record, I should say.
Pretty
so
impressive.
It's just continued to move higher. And, of course, all three major benchmarks ended up closing near their session highs.
There was some move into the red in the afternoon, not long after the Trump press conference.
Yep.
But as you say, all in the green.
All right, in terms of the different sectors, obviously it was all driven by Donald Trump's comments. We're going to start with healthcare because look at that big leg lower right around 11:30 or so. That was when Donald Trump had some critical words for the pharma industry, signaling he will force companies to bid for government business in order to save the government money. This is something he'll likely get Democrats' support on. If you look at the names involved, Endo Pharmaceuticals, one of them, as well as Mallinckrodt, Perrigo, each down by more than 6%, almost 7% in that in the case of Mallinckrodt. Street tracks biotech ETF. This is XBI. This is the ETF that tracks biotech, off by 3.4%. Biotech, a big loser today. On the flip side, we saw energy shares among the big gainers as oil prices rallied during the news conference. The XLE up by better than 1%. Transocean, Conoco, and of course ExxonMobil I added in there because Rex Tillerson is on Capitol Hill with his confirmation hearing. And a mention, speaking of ETFs, of EWZ, which is the ETF that tracks Brazilian shares. You can see that at around 3 p.m. they got a boost, and that is after Brazil's central bank unexpectedly cut its benchmark interest rate by 0.75 of a point. Policymakers looking to jumpstart the economy there. This was not anticipated. Only 4 of the 48 analysts that we surveyed expected such a large cut.
Let's take a look at the government bond market. Here we go. Not a ton of action in the U.S. 2-year yields unchanged. No real movement there. 10-year yields down by just a little bit. Basically no action on the long end either. But I want to spotlight what's going on in Turkey, where the lira continues to plunge. Here's a 1-year chart of Turkish 10-year yields. Absolutely surging lately, up to 6.09%. You can see just back this summer it was below 4%. So amid all the political chaos, the inflation, the weak economic data, not pretty for Turkish 10-year yields.
All right, and in terms of currencies, come inside the Bloomberg, because this is the Bloomberg Dollar Index. It erased its gains during the news conference, the Donald Trump news conference. It recovered, and then it started losing steam again, this time for good, down by 0.2%. Mr. Trump was silent on fiscal stimulus, and we see a little bit of those pre-Donald Trump trades being unwound. And I'm going to add in here the Mexican peso for good measure as well, because that's another one we've been watching.
Look at all those spikes up and down.
Exactly. The peso initially rallied when Donald Trump didn't mention the wall. That was a bit of a head fake, because later on he did mention it, and he repeated his pledge to build a wall and make Mexico pay for it, even if it's after the wall is built. So presumably the U.S. would pay for it first, and then he'd extract the money from Mexico somehow.
Finally, a quick look at commodities, oil and gold. Oil down there at the bottom gaining 3%. On reports, Saudi Arabia is cutting some of its volume sales to China. So some pickup there, and gold not moving much, but gaining 0.5%.
All right, and it continues that January gain, right?
Yeah,
because
gold's been just on this nice, steady ascent, hasn't it?
It's because of the Lunar New Year, the physical demand for gold.
We should do, reminder, we should do a segment on that.
Okay, all right. Well, Tanya, are you listening? Keep that in mind. All right, those are today's Market Minutes.
For more on the markets, I want to bring in Michael Cugino, Pacific Heights Asset Manager, Portfolio Manager, and CEO. He joins us from San Francisco. Michael, thank you very much. So, you know, lots of concerns right now in this market. We've seemed to have stalled out. We gained today, but feels like some of the post-election rally has stalled a little bit. Interest rates have, after spiking up, have kind of declined again. So a lot of these post-election moves have either stalled out or reversed. Is this going to continue for a while? Are we in this holding pattern? Like, where do we go from here?
Well, reality's setting in. We've got an inauguration in, 10 or 9 days. And so I think that, all of a sudden we go from optimism and hope about the future to the reality of actually getting policy and realizing some of these expected benefits to occur. So, I mean, basically, since the election, you had improving data in the third quarter, and hopefully that continues in the fourth and early in the year here. But you had a revaluation of equity and bond markets based on the election results, the makeup of Congress, et cetera, and the expectation of better business environment, more dynamic growth, lower taxes, less regulation, et cetera. And so now we're pivoting to confirming those expectations, and it's going to make for an interesting year in 2017, because I don't think it's going to happen all at once, and the benefits are going to take a while to be realized. So we're going to have some volatility along the way, I think.
Right. I wonder which asset class is leading. I mean, are we looking at the dollar, for instance? I mentioned how the Bloomberg Dollar Index was higher, but it lost ground during the news conference because there was no mention of fiscal stimulus. And if you look at it year to date, it's fallen as much as 1.4%. Is that the driver for everything else?
I don't know if it's the driver, but it's definitely one of. So many things impact the dollar, whether it's U.S. activity, interest rates, monetary policy vis-a-vis the rest of the world. So it is definitely a major factor. The higher the dollar goes and the lower everybody else is, that may impact U.S. exports. And so that's an issue that does eat into the U.S. growth story. On the other hand, if you have global growth and a generally rising interest rate environment throughout the rest of the world, the dollar would likely sell off vis-a-vis those interest rates and thereby improve that, that export picture for the U.S. So there's a lot of different nuances to the dollar, but it is something to watch because it will impact how things go this year.
Let's talk about valuations and what happens if rates keep going up. I think there's probably one of the arguments that the bulls made for a long time was that valuations weren't particularly bad given ultra-low interest rates. We've seen rates tick up a little bit, and yet equities have hardly been affected at all. If rates keep going up, what does that do for equity? At some point, does that cause pain for equity markets?
I think the real issue is how quickly interest rates go up, and is it a shock factor or do they rise gradually? Gradually rising interest rates are a byproduct of a healthy, growing economy. So if you get that and you have a gradual rise in interest rates along the way, I don't see that as a problem. Yeah, we're coming off the lows. Maybe we are at the end of the bond market rally. There's been a lot of discussion about that lately. But I'm not in the camp that if the 10-year goes to 3%, for example, that the economy is going to crash. I think if it goes to 3% for the right reasons and the curve adjusts and it's still sloped properly and you have economic growth, I don't see that as a problem. And historically, while that number would be high based on recent history, broader historical numbers, that wouldn't be that high at all. And so interest rates bear watching for a lot of reasons, but the rate of increase and why, I think, is more important than the actual number as to how they go up. With respect to equity values, yeah, I think we're in a revaluation situation here where we're going to have to confirm the hope and optimism for some of these better business policies that everybody's been talking about. And that confirmation is going to occur sometime in the future.
Well, there's valuations, and then there's also name-checking by the president-elect. Barry Ritholtz, one of our Bloomberg contributors, has put together a chart that illustrates this. He calls it an oligarch index versus a drain-the-swamp index. The oligarch index is a custom index made up of companies like ExxonMobil, Colony Capital, Facebook, Ford, Goldman Sachs, basically companies that Donald Trump has praised or sounded positive on, right? The other index, the Drain the Swamp Index, the bottom line there is made up of Amazon, Boeing, GM, Kellogg, Lockheed Martin, New York Times, Time Warner, companies that he's disparaged in one way or another.
Love this chart.
For instance, through tweets. Is it as simple as just following what Donald Trump says and buying off of that or selling off of that, Michael?
I think if you're a trader, that presents a lot of short-term opportunity. We're not. We're long-term investors, and I tend to think that over the long term, these tweets don't really matter that much. For example, I think in the short term, a comment about Lockheed Martin, for example, might drop the stock a couple points. You get frustrated as an investor, but in the long term, that's a great long-term growth story. Whether they're building aircraft for private companies or the government, they're still going to be doing it, and over time, I think it's a great story. I would say the same thing with about a lot of the, healthcare sold off quite a bit today, especially the biotechs, and I would say that's a dynamic growth industry, and so, yeah, it presents some opportunities as a long-term investor to potentially buy. But I don't think as a long-term investor that's a strategy that I would use. In terms of overall valuations, I mean, the S&P 500, broadly speaking, is pretty fairly valued to maybe slightly richly valued right now. And so the next step is going to be earnings growth, and we've got to see earnings growth to sort of reval again on the upside. And there's been a lot of estimates as to where those are going. I think we're looking for mid-single digits, which even mid-single digit growth, you're looking at a multiple of probably 16, 17, 18 in that range, depending on where you cut it. So a lot of the potential gains are priced in. If you get really dynamic earnings growth, then you could see multiple expansion and further dynamic gains from here. But there's going to be a period of sort of prove it to me that's going to occur in 17.
Michael, you make a good argument that we shouldn't focus too much on, say, a tweet about a specific company. But what about the fact that Trump seems very serious about this anti-trade, anti-globalization, anti-offshoring strategy? He's very consistent on his message. And what I'm trying to figure out is investors seem very excited about tax cuts and regulatory rollbacks, two things he's hardly talked about at all. And are they ignoring what he has talked a lot about, at least thematically, which is he's very serious about sort of changing trade policy in America?
You know, the devil's in the details on that sort of stuff, and I don't think we know enough to comment, and I think it can be misleading to just go on headlines. The fact of the matter is that I think a focus on U.S. interests and U.S. businesses is a positive, and to the extent that you can entice businesses, I think there's been somewhat misplaced emphasis on, you know, Donald Trump tweets and Ford and other companies, you know, jump to attention. I think the fact of the matter is that he's been pushing a pro-America agenda, making the U.S. a better environment for companies to expand and grow through these policies of less taxes, better margins, less regulation, et cetera. And to the extent you do that, then companies are going to want to come here. And some of the trade issues and imbalance issues and immigration issues and inversion issues that maybe we've been dealing with the last several years begin to go away because you've made it attractive to do business here. And I think that's sort of broadly where he's going. And I think it's a positive in the long term.
All right, Michael Cugino, Pacific Heights Asset Management CEO and Portfolio Manager, thank you very much.
Thanks.
We have some breaking news. Johnson & Johnson has tentatively agreed with Actelion on a price to acquire that company. This is according to Bloomberg reporting, which cites people familiar with the matter who don't want to be named. Talks are now focused on valuing what would be a new unit that would house the research and development assets. So again, J&J and Actelion said to reach a tentative agreement on price. They're now just figuring out the value and the ownership of the R&D spinoff that comes along with it as well. So we'll keep you posted on any further developments here on J&J. Coming up, speaking of healthcare, how will healthcare companies deal with President-elect Donald Trump, who stressed today that his administration will be a tough negotiating partner for the industry? We will speak with GlaxoSmithKline Chief Strategy Officer David Redfern. This is Bloomberg.
I'm Elisa Parenti, and this is Bloomberg. We're looking now at a live shot of Rex Tillerson. He is responding to questions as he testifies, as he goes about being confirmed for the Secretary of State position. The former CEO of Exxon has suggested the outgoing Obama administration responded too softly to Moscow's takeover of Ukrainian territory. That among some of the testimony that we're hearing. We are continuing to follow this story and the confirmation hearings, and we'll bring you the latest as those issues evolve and develop. Now, in other first word news, President-elect Donald Trump, in his first news conference since winning the presidency in November, reiterated today that appealing the Affordable Care Act will be at the very top of his agenda when he takes office.
As soon as our secretary is approved, almost simultaneously, shortly thereafter, a plan. It'll be repeal and replace. It will be essentially simultaneously.
Trump has cautioned Republicans to let Democrats take the blame for problems with the ACA. And President Obama's tweet after his farewell address has become the most popular post on the presidential account. Obama tweeted from the POTUS account last night, "Thank you for everything. My last ask is the same as my first. I'm asking you to believe not in my ability to create change, but in yours." The message has been retweeted more than 600,000 times. Global news 24 hours a day, powered by more than 2,600 journalists and analysts in more than 120 countries. I'm Elisa Parenti. This is Bloomberg. Scarlet?
Thank you so much, Elisa. What'd you miss? Pharmaceutical and biotech stocks took a dive when President-elect Donald Trump commented on the industry's drug pricing methods earlier today.
They're getting away with murder. Pharma has a lot of lobbies, a lot of lobbyists, and a lot of power. And there's very little bidding on drugs. We're the largest buyer of drugs in the world, and yet we don't bid properly. And we're going to start bidding. I'm going to save billions of dollars over a period of time.
GlaxoSmithKline dipped in U.S. trading. 38% of that company's revenue in the third quarter came from the U.S. Here now to talk about what's next for the company is David Redfern. He is GlaxoSmithKline's Chief Strategy Officer. David, good to speak with you. Thank you very much. I need to start first on the President-elect's comments on drug pricing. Certainly very strong words. From where you sit, what kind of influence will he have over how drug companies pursue their strategy, how they price things?
Well, good afternoon. Yeah, it's been very clear, actually, at the JPM Health Conference all week that pharmaceutical pricing is a big theme, and obviously that's continued today with Mr. Trump's remarks. I think it really reflects a couple of things. It reflects, frankly, some excessive pricing that have obviously been very well publicized, but also actually a very general frustration with the whole healthcare system, the lack of transparency sometimes in it. We'll have to see how it plays through. I think we at GSK, over many years now, particularly under Sir Andrew Whitty's leadership, have tried to take a very responsible approach. We have priced actually all our new medicines, whether in respiratory or HIV, at or below the prevailing medicines in the market, even if sometimes the clinical data shows superiority. And I think also it's also worth remembering in this whole debate, at its best, the pharmaceutical industry does amazing things. I'm chairman of ViiV Healthcare. That's focused around HIV, and it's a very clear example. In 20 years, this industry, of which we've been part, has taken really a death sentence in HIV to something that can be well treated, well managed on one pill a day and lead an almost lifespan. So I think what's important in all this debate, as it plays through over the next few weeks and months, is that innovation and the ability of the industry to innovate and then price fairly that reflects an appropriate value for that medicine is still captured in whatever system evolves.
So how do you make that case politically, that what you do is worth paying the prices that people pay for it?
Well, I think ultimately you have to demonstrate the value of your medicines through your clinical trials and through increasingly real-world evidence. And obviously the private sector is a very important part of this, with the debate with the insurance companies and Part D as well. But obviously in Washington and through the Pharma Association with our American pharmaceutical colleagues and peers, we will be advocating that very, very appropriately and very forcefully. As I say, I do think a big part of this is much bigger than the pharmaceutical industry itself. It's part of the broader system, the lack of transparency in it, the huge differences sometimes between gross prices, the list prices and the net prices. So it needs a really fundamental look at the whole system, and we're very happy with the rest of the industry to be part of that debate.
I need to get your thoughts on M&A as well. We just broke the headlines that, according to Bloomberg reporting, Johnson & Johnson and Actelion have tentatively agreed on a price for J&J to acquire Actelion. What does that signal to you about the deal-making environment? What type of acquisitions, for instance, would GSK be interested in?
Well, I think, Scarlet, in terms of the general environment, I would expect more M&A this year. I think the conditions are kind of pretty well lined up for it. You've obviously got low financing costs. Most big pharma companies chasing more growth. Indeed, most CEOs actually talking, at least on bolt-on acquisitions, as being part of their strategy. And of course, if there is the overseas repatriation for the American companies, I'm sure that will fuel it. I think for GSK itself, we obviously did a very big deal 2 years ago with our transactions with Novartis, and we're very pleased with the way that's going. We combined our consumer businesses. That's going great. And we also bought the Novartis vaccine business. And again, the integration there, both top and bottom line, is coming through extremely well. So we're still focused on that. So most of our BD activity is probably at a much earlier phase of the pipeline. Licensing deals and so forth. So, we're bedding down what we've done, but I would expect M&A in the sector. I would think that would continue this year.
Sorry. David, turning back to Washington, obviously one of the big debates that's coming up is the future of the Affordable Care Act. A lot of questions about if it disappears, what it would be replaced with. Also the timing, whether it would be possible to repeal the ACA and then wait a while a replacement is figured out. What is the ideal way to move forward, and how chaotic and bad would it be from your perspective if the ACA were repealed without a new plan put in place immediately?
Well, I think, Joe, we just have to wait and see. I mean, there's obviously a lot of speculation right now. I hope in whatever happens, and particularly in the replacement measures, the 20 million or so patients or American citizens that got coverage and came into the system maintain that. Actually, it was pretty important to us, particularly in HIV. A lot of, several thousand new HIV-positive patients were able to get treated through the ACA, and it's important that retains. Beyond that, I mean, I think we're just going to have to see how the detail plays through and whether it's repealed and replaced at the same time, or whether it's more staggered. I can't really comment on all the different implications of that. There are so many moving parts. Sure. We will see over the next few weeks and months.
David, before we let you go, very quickly here, any update on Glaxo's plans on developing a vaccine for Zika?
We have a program in development for that. We're obviously working on that. We have a great platform of technology and vaccines that we can use for these kind of pandemic outbreaks. And we're also looking actually to be more generally prepared, because I think what Zika has showed us, and Ebola, and actually the pandemic flu, is the industry and actually the whole world has a bit of a knee-jerk reaction as these things come out, and we all have to run around. So we're looking actually to be working with all sorts of different partners, the WHO and so forth, to have a much more prepared approach to the whole thing, and so we can react accordingly as these new viruses break out.
David Redfern, GlaxoSmithKline Chief Strategy Officer, joining us from San Francisco. Thank you very much. From New York, this is Bloomberg.
I'm Joe Weisenthal. What you missed? Let's take a deep dive into the Bloomberg. You can find all these charts using the function at the bottom of your screen. Let's start with bonds. I'm looking at an unprecedented level of interest rate risk. This is in the Bloomberg Barclays U.S. Aggregate Bond Index, modified adjusted duration. Basically, what it's saying is the degree to which the bond market is at risk due to higher rates. And so there are various things that could affect the bond market. Higher rates is one of them. And as you can see, there's a huge surge in this risk. Yeah. People are piled on the extreme long end into these rate-sensitive products. It kind of makes sense that as the bull market continues, you would expect this to generally trend higher. But if, we've seen rates go higher, but if we see like a real upward shock in this, you could just see a lot of people losing a lot of money.
Although it's come back down a little bit from the peak at the end of last year, right? I mean, you do have...
It's a little bit down, but...
You have the 10-year yield kind of plateauing at this point. The yield curve has flattened just a bit. Tom Lee of Fundstrat was saying that the bond market is indicating some confusion here. Not quite sure whether inflation is really for real this time.
Exactly right.
All right, coming up next, we're going to hear from Senator Elizabeth Warren on why she's so concerned about Donald Trump's conflicts of interest. From New York, this is Bloomberg. I'm Elisa Parenti, and you are looking now at a live shot of Rex Tillerson, the nominee for Secretary of State, at his confirmation hearings. Earlier, we heard from Rex Tillerson that Islam is a, quote, great faith, and he doesn't support the blanket rejection of people from the United States because of their religion. President-elect Donald Trump said during the campaign, of course, that if elected, he would implement a total ban on Muslims entering the U.S. Trump has since proposed extreme vetting. We are also following Tillerson's response to his connections to Russia. He's actually taking a very strong approach to how he would
deal with Russia going forward if he were to be confirmed as Secretary of State. Kind of surprising because before he had talked about the benefits of a friendly relationship with that country. We are staying on top of the confirmation hearings and we'll bring you more as developments occur. And for more First Word news, Trump has chosen David Shulkin to head the Department of Veterans Affairs. He is currently the Undersecretary of Health at the VA. The VA system has a budget of about $180 billion. It's recently been engulfed in controversy. A review found treatment delays, mismanagement, and falsified records. A new U.S. government report says Afghan security forces still are not capable of securing the country by themselves. The Special Inspector General for Afghanistan finds the country needs a stable security environment to prevent it from again becoming attractive to al-Qaeda and other militants. It's been 2 years since NATO-led forces withdrew, leaving behind just a small number of troops. And Italian Premier Gentiloni is hospitalized after falling ill on his return trip from a meeting in Paris. An Italian news agency says Gentiloni underwent angioplasty surgery at a Rome hospital today and is in good condition and alert. The 62-year-old Gentiloni took over as premier last month after the previous government resigned. Global news 24 hours a day, powered by more than 2,600 journalists and analysts in more than 120 countries. I'm Elisa Parenti. This is Bloomberg. Joe?
Thanks, Elisa. Bloomberg's Kevin Cirilli caught up with Senator Elizabeth Warren earlier today. They discussed potential business conflicts of interest for Donald Trump. Kevin joins us now from Capitol Hill with the highlights. Kevin, thanks for joining us. So what did you learn from Elizabeth Warren? What's her perspective on Trump's conflict of interest?
Well, she doesn't like Donald Trump's remarks at his press conference. And, of course, Trump just moments earlier having laid out the steps that he would take to what he says allow a protection between his administration and the Trump organization. But she says it doesn't go far enough. Take a listen.
I'm more concerned now than ever because he's not moving where he needs to move. And that is, we need to have him divest. He needs to get rid of his business interests, and he needs to put them in what's called a blind trust.
So clearly, Democrats, along with people like Senator Elizabeth Warren, are saying that President-elect Trump would need to have a blind trust. Of course, he did not adopt that policy, instead opting for a different approach and obviously receiving a ton of criticism from Democrats already.
Very quickly here, Trump's pick for Treasury Secretary Steve Mnuchin did say he would divest his interest to avoid conflict. But what is Warren still worried about when it comes to his track record?
She says that he's too familiar with Goldman Sachs and with big banks. Take a listen to what she had to say about Mnuchin.
He's going to be the chief financial officer for the United States of America. So you really want to know, so how do you approach profits? How do you approach making money? His answer was, after his long time on Wall Street, was to buy a bank after the financial crisis, one that had a big portfolio of loans that a lot of people had been tricked on, a lot of people had been cheated on, and then aggressively to foreclose against those people.
So Elizabeth Warren obviously coming out against some of all of President-elect Trump's picks. But I asked her, of course, look, you don't have the numbers in the Senate to really block any of these picks. She says this is about continuing to pressure Republicans. Clearly, she's trying to find her role within this new Republican-controlled Congress in Trump's Washington after January 20th.
Kevin, today's Senate confirmations hearing continuing. Today was Rex Tillerson in the hot seat on answering questions. What is the latest going on there?
Well, I just spoke with Senator Rob Portman, actually, who is a member of the committee in which Rex Tillerson is currently testifying. He's one of those Republicans who had a lot of questions, such as, like others, Senator John McCain, about Tillerson's ties to Russia. And when my conversation with Senator Portman, he indicated that he was a bit satisfied with what Tillerson is testifying currently on Capitol Hill. So I think if you're a Republican and you're watching this and you're hearing Tillerson's testimony, he did what he needed to do. He adopted a more aggressive tone against Russia, and I would expect that he did the job. And if you're, again, in the President-elect's transition office, you're feeling pretty good about how Tillerson performed today on Capitol Hill.
So the theme here clearly clearly is conflicts of interest, whether we're talking about Tillerson, Mnuchin, or Donald Trump himself. What do concerned senators like Elizabeth Warren plan to do to keep these officials accountable in the event of an actual conflict of interest? I mean, how will they police this? How will they get Republicans on their side to police this?
I asked her that, and she's aware that because of the Republican majority, it's going to be particularly tough for them to be able to block any of these nominees. And yesterday on Capitol Hill, she and other Democratic colleagues of hers had a briefing in which they tried to raise these issues, if you will. But the bottom line is this is Trump's Washington. And so this is a very new political landscape, and one that she is having to recalibrate herself for as she looks to position herself not only in the Congress, but also as a force within the Democratic Party. All of that is being sorted out, but either way, she assured me she is not going to keep quiet on this, and I think we're going to be hearing a lot more from people like Senator Elizabeth Warren, and yes, also Senator Cory Booker.
All right, Kevin Cirilli, Bloomberg News, thank you very much.
Coming up, Brazil slashing its key interest rate unexpectedly by a large amount in order to revive its flatlining economy. Win Thin, Brown Brothers Harriman Global Head of EM Currency Strategy, joins us next with his perspective. This is Bloomberg. What you missed, Brazil unexpectedly slashed its benchmark interest rate as policymakers look to jumpstart that country's stagnant economy. Although we haven't seen a reaction in the real, one ETF, and here we're talking about EWZ, took a leg up on the news. You can see there the leg higher right at 3 p.m. Eastern Time. Joining us now is Win Thin, Global Head of Emerging Market Currency Strategy for Brown Brothers Harriman. And Win, of course, the surprise here was the size of the rate cut. It was pretty aggressive, a 75 basis point cut. Is this going to accomplish what Brazil is setting out to do?
Well, it's another step. Most, including myself, were looking for 50 basis points because they've only been doing 25 basis point increments so far. They've hinted at an acceleration, but to go from 25 to 75 is certainly a big jump. Inflation is coming down sharply, but more importantly, as you noted, the economy is really in the doldrums. Yes, recession has gone on and on. People keep marking down their forecast for 2017 and even 2018. So it's a good start, but they've got a long way to go. They've dug a huge hole that they have to climb out of.
You mentioned inflation has been heading down. I have a chart here on the Bloomberg, if we can go into it. The Brazil Misery Index is just a very crude way of assessing a nation's economy, literally unemployment plus inflation. It's come down quite a bit, though still very high by the measures of recent years. Beyond this central bank move, what still needs to happen to get things going and to continue to improve the economy?
The structural reforms is really a tough road. President Temer has done a decent job, but a lot of his fiscal reforms have already been watered down. Some of the debt restructuring has also been done at very lenient terms. So it's really sort of a half-baked attempt. I mean, he's not elected. I think that's the problem, is that he's going to run into opposition. We're in a deep recession. To take unpopular austerity measures when the unemployment is going up, recession, it's going to be very tough.
I have a question about those austerity measures. When you see, you often see this, a country gets into trouble, the government has to do fiscal consolidation. How much of that is just about the pure math, making sure that there's enough money to pay the debt, and how much of it is the symbolism that undertaking austerity measures, fiscal consolidation, is evidence of a government that basically has it together, is not promising everything, everyone, and thus giving people the confidence to, think there's going to be some sort of stable hand on the economy?
Absolutely. Well, it's a matter of both. I mean, they're running a budget deficit close to 10% of GDP, so that's a lot of debt they're issuing. So they need to, just for pure economics, they need to bring that down. Interest rates, lower interest rates will help service that debt, but we're talking about huge, massive, outstanding debt that's growing every year still. And I think you're right about the symbolism. Temer wants to portray a change from the past. We've come through several terms of both Lula and Rousseff of where there's been corruption, misuse, waste, et cetera, and he's trying to turn the corner. But again, the problem with fiscal consolidation is that it's hard to do it. When times are good, that's when you should be doing it.
Right.
It's only when things really start falling apart that they're forced to do that, and it makes it even tougher. It's counter-cyclical fiscal policy is very unpopular.
No elected leader wants to put himself in that position or herself in that position. I want to go back to inflation for a moment, because we said that inflation has been coming down, and last year was at 6.3% versus the 10.7% in 2015. Yet we're talking about globally a reflation story coming about, right? China producer prices are starting to climb again. People expect China to export some inflation. Can we really expect Brazilian inflation to stay settled at these levels of 6%?
That's the big question. It's going to be hard. The thing that we saw with Brazil, though, was last year and earlier this year, 2016 and part of 2015, I haven't reset to 2017 yet, we saw the weaker real really feeding into inflation. So it was a really negative feedback loop that caused a spike in inflation and the central bank had to hike. Now we're sort of maybe in a more of a virtuous cycle where the strong real is helping the inflation get brought down. But I agree with you, with commodity prices going up, I think most countries will be experiencing inflation. So the markets are looking for a very aggressive Brazil central bank easing, and it may not come to fruition because of those reasons that you mentioned.
All right, let's move to a country a little closer by, Mexico. Mexican peso just keeps getting hammered. It's the one thing that everyone kind of got right, which is that Trump would be a threat to the peso. Most of the other market calls people predicted didn't really turn out right, but that one clearly did. How much worse can this get for them?
Unfortunately, I think it can get a lot worse. It's very frustrating because the fundamentals of Mexico are decent. If you take the other, for example, Turkey, you can see why Turkey is just going down, the Turkish lira. Right. Mexico is very frustrating because the fundamentals are decent, but it really is this whole uncertainty with the political change in the U.S. To me, the game changer recently was the Ford decision to not build a plant or expand a plant in Mexico. I mean, that was really took the markets off guard. If you look at the charts, at that point, the peso had been steady to firmer since the election. And since then, it's been off to the races, the dollar versus the Mexican peso. And he talked about today in the press conference that there's going to be more news like this coming ahead. And that's what markets are really afraid of. Ultimately, the peso is undervalued by any measure. At some point, if and this is a very big if Trump were to step back from such an adversarial relationship with Mexico, then I think you'd see a really big rally in the peso. It's just pricing so much bad news and so much uncertainty. But it's a really big if. Today's press conference, he didn't back down from those three things. Big border tax for any companies that set up shop in Mexico, renegotiating free trade agreements, building the wall in charge of Mexico. These are the three big facets of his Mexican platform that he's so far sticking with.
So these are things that Mexico has no control over whatsoever. They kind of just have to wait, and they're on the receiving end of this. What should or what can the government do in the meantime to set itself up in a better position? Should it be pursuing closer ties with Canada, with other countries?
Unfortunately, I mean, it's such a close relationship. I think 85% of Mexican exports go to the U.S.
Yeah.
It's whole remittances and things like that. That's what's so, I think, earth-shattering, is that we had this very close relationship. It's been closer for the last 2 decades, and all of a sudden the U.S. is showing signs it's going to take a step back and go the other way. And it's very, very hard to figure out where it's going to actually happen. But for now, because there's uncertainty, the markets are just pricing the worst. If things are unknown, then you just assume the worst.
So the central bank, of course, has been selling dollars to try to intervene and support the peso, and it really has not worked. I mean, it's like throwing good money after bad. Do they continue with this strategy, or what is the alternative?
Yeah. Well, I have to say, I do have to say it's a little unfair when I think central banks kind of come under criticism saying, oh, well, this intervention didn't work. But they come out and said, look, we're not trying to protect any particular level. We're not trying to strengthen the peso. We know we're in a strong dollar environment. The peso can't escape that. But there have been such gappy, illiquid markets that they're just trying to come in and put a little two-way risk, two-way price action, supply some FX liquidity. But it's not something they can sustain. The reserves are around $175 billion. It sounds big, but $2 billion here, $2 billion there. They've got a lot of external debt to service, and it's pretty tough. I think they hike rates aggressively. They may have to go intermeeting. The next meeting isn't until February. They may have to go before if things continue like this.
Speaking of foreign currency reserves, obviously China at the top of everyone's mind these days. Pretty interesting start to the year for the UN with lots of surprise moves. What is the trend? Are we still in a general weakening trend, which we've seen for a while, or what's going to happen here?
I do believe it, that we are going to continue to see weakness, but it's not. Remember, the Chinese have tweaked their foreign exchange mechanism several times over the last year or two, and they basically want the yuan to trade more with sort of market forces. And if the market forces are saying the dollar's going up and EM is weakening, then the yuan should continue that. They tweaked the basket last week, I believe, or 2 weeks ago. They lowered the weight of the dollar, increased the weight of emerging markets. To me, it's kind of window dressing. To me, the currency will do what they want it to do, and this sort of maybe just helps justify movements. But yes.
And, of course, if we just want to illustrate the weaker yuan and the capital outflows, because the two go hand in hand. This is G#BTV4242. The bars indicate capital outflows, and it's been a long time, since March of 2014, that we've seen this consistent outflow, while the yuan, which is inverted here, continues to lose value against the dollar. What is it that Xi Jinping, the president of China, will be doing as he pushes ahead with leadership changes in China later this year as well? I mean, he, like Mexico, he kind of has to wait to see what happens with Trump.
Yeah, I mean, that's a very good point. A lot of attention is so focused on Mexico, but China is certainly in his President-elect's sort of sights, I guess.
Yeah.
He's mentioned it several times. To me, I think China's trying to pursue stability. I mean, as you mentioned, there's some political changes. Global investment, global backdrop is very, very tricky for emerging markets. I would point out that the capital outflows, again, it's just reflecting wider EM. If you look at all the fund measures, most money is coming out of EM. It's not just China. So everyone's we're having this rebalancing of global portfolios, away from EM back into, I think, the U.S. and other developed markets.
All right, Win Thin of Brown Brothers Harriman, he's staying with us, and we'll be talking about the Turkish lira's drastic drop. This is Bloomberg.
What you missed, the Turkish lira rounding off its biggest 5-day loss since 2008, the global financial crisis. And of course, this follows a pledge by the Central Bank of Turkey to support the currency that obviously did not have investors convinced. Since January 4th, Joe, the Turkish lira has dropped as much as 7.7% of its value. That's as its 10-year yield has spiked up by 45 basis points. So there doesn't seem to be any end in sight either. Everyone talks about the lack of liquidity and how that just kind of exacerbates the move.
Incredible move. All right, joining us now for more on the latest moves in Turkey is Riyad Hamadi, Bloomberg News managing editor for the Middle East and Africa. And still with us is Win Thin, global head of emerging market currency strategy for Brown Brothers Harriman. Riyad, thank you very much for joining us. So let's say people haven't been paying attention at all. The Turkish lira is getting clobbered. How would you describe this story? What's going on?
I would say it's politics, really. It's about the coup, what's been happening in Turkey. You had a coup, you have the violence going on, the terrorism, you have the war in southeast Turkey, and you have a president who should be, a figurehead really at the moment, who wants to have executive powers, who's insisting on changing the constitution, who's insisting on influencing the economy and making statements about what the central bank should be doing. So there's questions about, is the central bank really free to act, to do anything against the drop in the lira?
So this drop in the lira has taken the lira to record lows, and we repeat this over and over, day after day, Win.
Right.
At some point, a weak currency will help the country, right?
Yes, but it's too much of a good thing, as they say. I mean, it's gone beyond most metrics. I mean, even though I'm very negative on the Turkish lira, by most measures, it seems very overstretched. But as you point out, the political situation is terrible, and it's feeding into a very bad economic situation as well. So, while I hesitate to sort of pile on when things are going, I think this could keep going.
Riyad, you talk about the political system, and it seems like very frequently there are headlines about Erdogan calling on this or that monetary policy, or telling the banks to cut rates or stuff like that. It just doesn't. None of it seems to be working. Is the only hope that at some point he says, "Okay, this strategy I'm taking with regards to economic management, is it working? I need to pull back on some of this stuff"?
I think the only hope is that there's a normalization of politics in Turkey. Right now, I mean, you have this overlay of the purge after the coup against what they call the Gülenist terrorists, where, these people may be former Gülenists, or maybe they are Gülenists, we don't know, but it's impacting really every part of society, of Turkish society, which is causing a lot of uncertainty. So it almost doesn't matter whether these people it's fair to arrest them and kick them out of their jobs, but it's impacting the government's ability and the economy's ability to function.
We talk a lot about how FX is now the first area where you see political risk priced in, more so than fixed income or equities. And in Turkey, you have a populist leader, because he is still fairly popular, right, Erdogan. Is this what populism run amok looks like in the FX market, when you see the Turkish lira devalue to this extent and fall to record lows every day?
Yes. I would think the one thing I would add is that I think political risk has always been an EM. It's always been there. But when the cash is flowing in, commodities are through the roof, growth is 8%, 9%, what have you, it kind of masks a lot of the stuff. And we saw that in Brazil, South Africa, and we're seeing this in Turkey. So when the tide goes out, you really see which countries are really, really risky. And I think the politics is a much bigger story for 2017 for emerging markets.
Yeah.
Is this hurting Erdogan's popularity at all?
It's hard to say. So far, I mean, look, they've had, what, three elections in recent years.
And a failed coup.
Yes, and he keeps gaining in share and vote. I mean, last time it was almost half the vote. So he is genuinely popular. What he's afraid of, what he's concerned about, is that part of his reputation was based on the economy doing well, on people feeling wealthier. I mean, you talk to normal, regular Turks, they say, well, Erdogan has... I have a home now, I drive a nice car, so people felt wealthier. So he's worried that with this crisis, that the economic benefits, it'll become apparent to normal Turks that, oh, this is under threat. Hence, I think also that's why he's coming out and sort of being so forceful and saying, no, the central bank must keep interest rates low to encourage growth.
Bloomberg managing editor for the Middle East, Riyad Hamadi, thank you so much for joining us. Win Thin and Brown Brothers Harriman, thank you as well.
Coming up, what you need to know to gear up for tomorrow's trading day. This is Bloomberg.
What'd you miss? The NASDAQ climbed for a fifth straight day to a record high.
Pretty impressive.
All right, in terms of what we're looking at for tomorrow, don't miss this. More confirmation hearings on Capitol Hill. Dr. Ben Carson, remember him, nominee for Secretary of Housing and Urban Development. He will hold his confirmation hearing. And, of course, Congressman Mike Pompeo, the nominee for Director of CIA.
And don't miss this. Initial jobless claims coming out tomorrow morning at 8:30 a.m. Eastern Time.
And Fed Chair Janet Yellen holds a town hall meeting for educators. That will be tomorrow evening in Washington. That's all for What You Missed. Thanks for watching.
Have a great evening. This is Bloomberg.
I'm Heidi Lun in Sydney. You're watching Bloomberg Technology. Let's start with a check of your first word news.